Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Hi, Will. How are you?
I'm doing pretty well. It's an exciting day for you guys. You're hosting one of the bigger ag outlook conferences, economic outlook conferences in the country. Can you tell me about that?
Yeah, so every year the Midwest ag economists from all the different land grant institutions and 1860 schools and really ag economists from businesses and ERS, the universities, we all get together. And this is our chance to get together and kind of compare notes and stories and research and kind of just talk to each other about what we see going on. And it's a great avenue that if we have a hunch or if we want to just throw something against the wall and see if it sticks, this is a great avenue to do that before we hit the road and talk to farmers this fall. Kind of just air it out a little bit and see where the confrontation might be. So it's a lot of fun. It is our turn to host here at the University of Missouri. So right across the aisle over here is a group of people that I'm in charge of managing and herding this week. So I'm a little out of breath myself.
You got to take those cattleman skills with you over there.
That's right. That's right.
So looking at the markets, where are we sitting now? What kind of changes have we seen over the last week?
Yeah, largely up across the board, actually. Old crop corn for September up 19 cents to $6.27. New crop corn in December up 21 cents to $6.28. Old crop soybeans for September up 27 cents to $14.91. New crop soybeans in November up 11 cents to $14.11. The soybean oil prices up almost 4 cents per pound to just under 70 cents per pound. Soybean meal up $16.60 per short ton. Old crop wheat for September up 29 cents to 8.08. And then new crop July wheat up 17 cents to 8.47. So largely higher across the board.
So what really led the way up? What was giving support to the market this week?
Couple of things, actually. The big ones came at the end of last week on Friday with the USDA reports, but we'll kind of go through some of these highlights here real quick. On the consumer side, we don't talk a lot about as much about the consumer price index as some of our meat colleagues, but the consumer price index last week came in at 8.5% year over year, which was flat compared to June. Economists had it signaled a slight increase, but it was flat. However, it's still 8.5% higher this year than last year. U.S. weekly ethanol production came down 21,000 barrels per day last week, or roughly 6.1 million gallons on the week. Export sales last week were a little better for corn and wheat, but still negative for soybeans and grain sorghum. Both old and new crop export sales are dragging heading into the final weeks of the marketing year here. Just 2 weeks left, actually. Open interest for Chicago soybeans increased 2%, while Chicago corn was down 2%, and wheat was basically flat week on week. Managed money traders also added net long contracts across all three commodities, leading to a shrinkage in net short positions for wheat and adding to those net longs for corn and soybeans. Brazil's version of USDA CONAB released estimates for their 2021-22 corn production. It's estimated at just under 115 million metric tons. That compares to the 87 million metric tons last year. On Friday in the USDA reports, the big report day, USDA did re-interview growers in the Upper Plains, North Dakota, South Dakota, and Minnesota. We did see some acreage revisions, about 100,000 fewer acres of wheat, 100,000 fewer acres of corn, and then 300,000 fewer acres of soybeans. Weekly grain export inspections were down week over week across the board. The National Oilseed Processors Association this month for July, yesterday on Monday, reported that their members crushed 170 million bushels in July, coming in below the 171.5 million bushels that the trade was expecting. And then the conditions ratings fell for corn and wheat by a point. Gosh, I'm out of breath after reading all that. There was a lot more there than I thought there was, Will.
Well, there's always, it seems like this time of year, there's always a lot to keep in mind because, you're not just watching general market factors. How the crop is actually physically doing is, half the battle. So that's always adding more stuff to it.
Not only that, but some of these weekly, like exports, for instance, this time of year, they really matter because we're 2 weeks away from the end. Wheat, we're not talking about wheat exports because we got a long way to go. But for corn and soybeans, it matters.
Yeah.
So a lot going on.
Well, just on the exports real fast before we dive into our main topics, it's been kind of interesting because we've been seeing a lot of, I guess in the last several weeks, cancellations or net negatives on things like soybeans. What are you seeing, the tides? How are the trends going right now for corn and soybean exports?
Well, we're kind of limping into the year, really, and this was a topic of conversation. Exports was our, corn and soybeans, and exports was the focus this morning at the Economist meeting. I was talking about the Midwest Ag Outlook, and the general assessment by people is we're very concerned about exports, especially of corn and soybeans, into the Chinese market. The drag on the economy over there potentially has a bigger play on corn and soybeans than it does meats, because recessions don't hit every income group the same. So if you think about those top income groups in China, the ones that are largely buying meat products and are largely importing the pork and beef from the United States, they're largely going to still have the money to be able to afford that. Whereas the corn and soybeans, when we start thinking about feeding margins for other products, it could become tighter. And so I think that was kind of that was one of the things there, but we're kind of limping into the year. And then always, there's always this discussion about why is China, especially China, but all countries, why are they allowed to put sales on the books and make a commitment and then cancel them, throughout the year? The answer to that is, they're relatively small cancellations in the broader scheme of things. But then the other thing is we call it washing out. So some of these sales get canceled and then put back on the books for the next marketing year.
Yeah.
And so they get moved to a different marketing year based on timing, based on logistics and stuff like that. So it's hard to do they make a difference for the marketing year? Absolutely. In the broader scheme, are we actually losing them? Nah, not really.
Well, looking at those cancellations, and this is, me not really knowing exactly how all this works logistically. So let's say that there's something already loaded on a ship. It's, going across the pond there. Can it be canceled basically right up until the time that it's received?
No, there are limits. There are limits, and I think so. The phrase, if you talk to grain traders, like if you go to any of the grain trading major companies, or even your local trade elevator, your country elevators, they'll tell you that they're not grain traders; they're transportation traders. They're trading freight. And that's the same story is happening on this international market when we talk about exports, right? They're maybe canceling a sale here because they can get a better rate due to exchange rates and transportation somewhere else. And so they're playing that game a little bit, but then somebody's still buying the product, right? So we do see this reshuffling. We do see this movement around. It is frustrating because we tend to think of a contract, right? I have to sign a contract with my elevator when I enter a futures contract or a forward contract. Why don't international buyers have to do that same thing too? And I get the frustration. I do.
Well, one of the things that's been interesting the last several months is as fuel prices have been so volatile, and we're seeing those big climbs, now some drawbacks and the adjustments there. Talking with I guess export managers, they said we used to be able to guarantee a month out what something might cost. We give them a quote. Now within a week, you only get 3 or 4 days where that quote might be valid. So how much of a role does that play in these possible cancellations?
Oh, so this is just a comment on the broader market. I have a great slide. I wish I could pop a slide up here at the show because, so we are dealing with great volatility, and it's not the same textbook definition of volatility that the futures market relies on. I'm talking about big fundamental shifts up and down in these commodity markets. And the slide I have that I show has basically a 5-year period of corn and soybean futures prices. And you see, the higher prices here as of late, but then these big down, drop $1, up $1, down $1.50, things like that. And the interesting thing, the reason I'm telling you this is because if you look at that chart, you can't hardly see where the trade war was in 2018. You can't hardly see where COVID was in the spring of 2020, because the back end is just so drastic, right? And that's what we're dealing. It's not the textbook level of volatility, but it's these waves and movement as fundamentals are changing and things like that. And so I think that's why people, wheat is a classic example from this summer. Elevators just, futures prices were going up, and elevators say, we're not buying. End users said, we're not buying. And as a result, producers were left out of that market because there was, great price movement that was happening. So good question. I don't know how it impacts. That's my way of dancing around the subject about how it impacts exports. It's just broader than export sales because of this major movement that we're seeing in prices.
Yeah, well, it eventually gets to a point where how do you start digesting everything that could be a market mover, you know?
That's right.
But I don't want to spend the whole time on this. I also want to bring up the IRA, and it has nothing to do with Ireland. Has nothing to do with them in the 90s. So the Inflation Reduction Act, that's been a hot topic the last several weeks, obviously, as well. What impact has that have, and could that continue to have on the markets, if any?
Yeah, and you probably just saw me look over here. I was trying to see if President Biden had signed the agreement. And it looks like he did just an hour ago. So it is signed. It is now law. Um, the big thing in there that I think is noteworthy from a commodity market standpoint, that is a potential game changer, is the provisions in there for credits, sellable credits for sustainable aviation fuel. This is airplane fuel that's made from a renewable source. It could be ethanol. It could be taking ethanol and refining it in a different way to make renewable or sustainable aviation fuel. It can be soybean oil that turns into that. There's credits here, and we're talking anywhere from like $1.50 to $1.75 based on the carbon intensity score. And there's credits for this, and we're trying to understand how this works. The reason I say that this is so significant in terms of a push is last fall was when people started kicking the tires about this whole idea of, well, can we do something with it? Like what can we do for the aviation the industry, airlines? And to go from kicking like the thought of, do we even need to do something? Should we do something from a policy standpoint? To now it's not only law, but it has a pretty substantial tax credit, or not tax, but a credit that you can sell to go with it. This could be the major game changer for ethanol, that pulls ethanol from kind of a flatlined outlook into, hey, can we now use ethanol to produce sustainable aviation fuel? That's a big deal, and certainly I think that's the big thing, and that related to grain markets. Now, there's a whole bunch of other stuff that we could talk about, but I'll stop there and we'll save the rest for a conversation another day.
Well, real fast, just I don't want to be the guy raining on the parade talking about the potential that this could mean for ethanol and corn, and maybe some carryover into other commodities too. One of the concerns I have heard, though, that as it pertains to other energy sources, it also provides funding for maybe solar, electricity, things like that. Is there an outlook or potential there for maybe that to start taking over more of maybe the general transportation market when you're looking at cars and trucks?
Yeah, so this gets back into discussion, a long-running discussion, actually. So when oil prices got high this summer, gasoline prices went up. That's an incentive to switch to electric vehicles and stuff like that. What I see in this bill probably isn't necessarily as much of an incentive for consumers to switch as what that high oil prices were kind of back this summer. I do think that was we saw changes in driving behavior as a result of that. So I don't think this has that big of an impact. Where I see this playing in is if you are using electric vehicles, or if you want to invest in an electric vehicle or sell your electric vehicle, there is money there. And so I think this really kind of goes to a maybe niche part of the market to some extent. And when I think about the broader ethanol market, I still believe exports for ethanol are where we need to focus rather than fighting some of our domestic headwinds. Because look at Europe, their natural gas prices over there are going to really curtail their ethanol production, and that provides us an opportunity to export ethanol into their market in the next year.
Well, and it seems to me, and you could totally disagree with me on this part, but it seems to me that we're at the very end of the, I guess, quote unquote, early adapter phase within electric vehicles, within EVs, and it's going to become more and more common. You talked about charging stations, I know, several months ago popping up in and around your hometown. So I think as we see that might further, I guess, open the door for more consumers. So we'll see how that, I guess, but.
Motor vehicleists are, they're consumers of habit in aggregate. So across the board, they buy what they want. That's why we've struggled with this E15, right? Like there's a huge premium for consumers to buy E15. We can talk about why the infrastructure is not going in, why retail stores aren't putting it in. But by and large, when a person goes up to the pump, they might not even look at the prices of all of them. They're just like, yep, yellow handle or green handle, whatever the handle is in your state, that's what I'm going into. That's what I'm putting into my car, because that's what I've always put into my car. It's very much a place of habit. The gas station is for consumers.
Well, I was in St. Louis the other day, and I was putting E85 in my car, and I look around, I noticed everyone else, even though there's like a 70-cent gap, everyone else was generally, sticking with the regular unleaded, or doing whatever. I was like, yeah, it's interesting. All right.
And I'll probably get beat up by saying that consumers don't look at the price incentives. But my gosh, with these price incentives that we are seeing for consumers, we should see a lot more uptake than what we have. And again, some of that's availability. I get it. But even in areas with broad availability of, some of these higher blends, you still got the same people going to the pump. This is the handle I always get, not even looking at the price. Because what are you going to do? There's people that drive and don't even look at price of gas because they have to do it to get to work or to take their kids to soccer practice. It's not a question. Now there's other people that, yes, it's very much a part of that picture. So
I hate to do this to you. We only have a couple of minutes, but we're going to get to a little bit of WASD discussion. I guess, what are your general thoughts following that report?
Yeah, a couple of thoughts real quick. I am very okay with what USDA did across the board, both from the National Ag Statistics side, resurveying acres. I liked the acreage shifts for the Upper Plains, or it's not resurvey, re-interview, and I liked their yield forecast. And I'll tell you why I support the yield forecast increase for soybeans. If we get some timely rains, which we're getting a timely rain here in Missouri, it's going to make a heck of a soybean crop. We're going to have a good soybean crop. And so I'm fine with that estimate, taking it up to tie the record breaking. I liked what the Chief Economist's Office and WASD did, or the World Ag Outlook Board did, on the demand side. I have no complaints across the board. I certainly think, the big change this year was taking 2.6 million acres out of the soybean picture back in June. And that was a farmer-led effort, not a USDA, but that totally changed the picture for soybeans.
All right. Well, wrapping up, what reports should we be watching this coming week?
Yeah, so a little bit quieter of a week than what we just had. But ethanol report comes out on Wednesday, export sales Thursday morning next week. And then the one that we watch here on the grain side, that's really for our livestock folks, is the cattle on feed next Friday at 2.
All right. Well, Ben, I always appreciate your time. Go slam that coffee that's in behind you and get back to your conference, I guess. So
Thank you. I'm living off coffee right now, Will.
Yeah, that's the only way to do it. So, all right. Well, if you'd like to learn more or go check out our counterparts with the weekly livestock market update, you can do so at brownfieldagnews.com. I'm Will Robinson on Brownfield.